probably are in a recession. The thing is, the official scorekeeper, this is for the United States, not the world. We probably are in a recession. The thing is, the official scorekeeper, this is for the United States, not the world. A world recession is rare, by the way. Usually, one sector, Europe or the United States or Asia could be in a recession. Others might be doing better, trying to pull the world economy out a bit. But a global recession, they do happen, but they're quite rare. But just with reference with regard to the United States, there's this National Bureau of Economic Research. It's a bunch of egghead economists up in Cambridge. And they're the official, unofficial scorekeepers. So they tell you when you have a recession, when you're out of it, et cetera. And that's widely accepted. The problem is they usually tell you you've entered a recession about 6 months after it's over. So you can't really rely on them. So you have to look at a lot of other metrics, predictive analytics and so forth too, if you want to either predict it or just kind of know it in real time. There are a lot of them, but one is, the Federal Reserve Bank of Atlanta has a tracker. It's called GDP Now. It's actually pretty good. Some of these statistical methods, certainly the ones at Wall Street, aren't worth our time. But the Atlanta Fed is a pretty good tracker. It went from, round numbers, kind of positive 2.4% for the first quarter of 2025 to negative 2.7% in a matter of days. And it looks like an Acapulco cliff dive. It went straight down. And they said, well, the reason is because of Trump's tariff proposals. And, he puts them on, takes them off. No one really knows. But because of that, there was a surge of imports. People were trying to actually get stuff into the United States before the tariffs hit. And, of course, imports increased the trade deficit, which decreases GDP. And that was the explanation for that. Probably something to that, but there's just a lot else going on. We're not quite at the stage of mass layoffs, but hiring hit a wall about 6 months ago, a little bit longer, where they just stopped. Basically, people weren't hiring anymore. Firing people is the last thing you do. By the time you get to the layoff stage and see unemployment going up, that's a sign, that's a lagging indicator. You're probably already in the recession because it's so hard to find people, train them, get them going. It's the last thing you want to do. So you'll, cut out the laundry bill, turn down the electricity, negotiate the rate. You'll do a lot else before you lay people off. When you start doing that, we're getting close to that point now. There's been some big layoffs announced recently. So that's another indicator that we're probably already in it. But new hiring stopped, as I say, 6 months ago. There's some technical indicators. Not to get too down in the weeds, but the yield curve is the shape of the yield curve is one of the best economic forecasting tools out there. Well, fortunately, this is an easy one. So the yield curve is just a typical curve. So the y-axis, the vertical axis, are interest rates, and the x-axis, the horizontal axis, are maturities. So the U.S. Treasury, people say, government securities. Well, okay, but there's a 1 month bill, a 3 month bill, a 1 year, a 2 year note, a 5 year note, all the way out to a 30-year bond. So that's the x-axis. So the y-axis are interest rates. Every one of those has a different interest rate. They can be close or there could be a spread. And all you do is you plot those interest rates. So what's a normal yield curve? A normal yield curve is upwardly sloping from left to right. And that makes sense. Longer maturity, if I'm going to lend to you overnight, I might want one rate. If I'm going to lend you for 10 years, I say, well, a lot could happen in 10 years. So I'm going to want a higher rate. So an upwardly sloping yield curve is normal. But periodically, and it's not that unusual, a little bit unusual, you get a downward sloping yield curve where the longer maturities have lower interest rates. What does that tell you? Well, the Treasury market, that's the big money. I used to work for a primary dealer. We were one of the ones authorized to deal directly with the Fed. There are only about 20 banks with that status. So you talk to the Fed every day. A downward sloping yield curve, and this is where, again, the big money kind of sets this, the market sets this, tells you that a recession is coming. And how do you draw that inference? Well, let's say short-term interest rates are 4%. And longer-term interest rates are 3%. Or actually, the actual numbers now are closer to 5 and 4. So, but you say, well, gee, I'll take a 4% coupon, 4% yield to maturity on a 10-year note, because that's going to look really sweet a couple of years from now when interest rates are 1.5. When the recession kicks in and interest rate collapse, that high coupon is going to look very attractive, number one. Number two, bond math 101 is kind of counterintuitive, but when interest rates go down, prices go up. And when interest rates go up, prices go down. So if you believe recession's coming and interest rates are coming down, you'll lock in the higher coupon now, and when interest rates do come down, you'll have capital gains on that note. So it's a really attractive trade. So, but meanwhile, back here at the short end of the curve, 30-day bills or three-month bills or 6-month bills or whatever, that really is much more subject to Federal Reserve control. It's about the only thing they control, this idea that the Fed can control long-term rates by manipulating short-term rates, because this is just the value of a strip of short-term rates. Well, that's all nonsense. I mean, that's a theory. You can do the math, but that's all nonsense. So the point being, when you have a downward sloping yield curve, that's a sign that the recession is coming. But the people are the biggest institutions in the world. This curve is set by sovereign wealth funds, endowments, pension funds, insurance companies, the players in that market. It's not that they're infallible, but they are. It's basically a distillation of all the big money in the world, kind of saying something to you. And so you should kind of just the math is simple, the yield curve is simple to look at, but you have to know what it means. And so the downward sloping yield curve, which did start about 1.5 years ago, said that the recession is coming. Now, what's happened in the meantime? The yield curve has flattened. It's actually what's called a bear flattener, where short-term rates came down a lot. Long-term rates came down a little bit, but now it's kind of flat, and it's actually getting back to a normal shape. What does that tell you? It tells you the recession's here. Now that the recession's here, short-term rates should come down a lot, and they have. And this idea that the Fed is, they do have an influence, so I don't want to dismiss them entirely, but I'll come close. The Fed is not leading the market. The Fed is following the market. The best short-term rate indicators are 1-month Treasury bill. There's something called the secured overnight financing rate. It replaced LIBOR. It's a clunky form of LIBOR. But both of those rates, the secured overnight funding and the 1-month bill, are lower than the Fed funds target rate. So what that tells you is that the market is sensing exactly what I'm describing. Those rates are going down. So whether the Fed's going to whether they cut or pause at a given meeting, I watch it, and it's pretty easy to forecast. But it sort of doesn't matter. And what I'm saying is the Fed's irrelevant. The market's taking interest rates where they need to go. So now that the curve is going from inverted, where the intermediate term rates are lower, that's the signal. Now it's flattened. It's getting into a normal shape, but all of the rates are coming down. That's the signal that the recession is here. By the way, this idea, we'll stimulate the economy with lower rates, that's nonsense. It doesn't stimulate anything. Low rates are associated with recession, depression, and financial panic. That's when you get low rates, three pretty bad things. In a robust growing economy, rates will be higher. Now, I'm not saying sky high, maybe 4%, 5%, but what that tells you is that a borrower expects a higher return. If I think I can get 10% on my investment or more, I'll happily borrow at 4% or 5%. There's also competition for funds. The banks actually love that environment. They have positive spreads. So a robust economy, you'll see interest rates of 3, 4, 5%, sometimes a little more. In a sick economy, recession or depression, you'll see rates of 1% to 0, which is where we're heading. But 2025, we've got a hangover from Biden's Inflation Reduction Act. It was really Pelosi's Inflation Reduction Act, which was not only misnamed. That was the Green New Scam. That's the hangover. The inflation that we saw in 2022 and lingering even today, it's not as high, but it's still there, was because of this pumping too much money into an economy that couldn't absorb it. And that is a cause of inflation. It's nothing to do with the Fed or money printing. That's all nonsense. It does have to do with fiscal policy and huge budget deficits. Coming into Biden, we had a baseline deficit, like the deficit that's just there. If you kept everything the same, $1 trillion a year, which is a big number. But today it's beyond $2 trillion a year. So even if you cut $1 trillion out, which is good luck. They're trying, but even if you cut $1 trillion out, which is almost impossible, you'd still have $1 trillion deficit left over. But we're trying. But this Inflation Reduction Act, I mean, there are new studies coming out showing that the impact of it will add $6 trillion to the deficit over a period of about 20 years. That was it. The way they scoring is a term of art, but the Congress has to score a piece of legislation to figure out how you're going to pay for it, et cetera. But they have a horizon. It's 5 years or 7 years, depending on what the OMB wants. But it doesn't mean the law goes away in 7 years. It just means that we're only going to count 7 years. But as long as it's on the books, it goes on forever. And this new study from the Cato Institute shows that actual cost is going to be in the tens of trillions of dollars. So can we get that amended or rescinded somehow? Let's see. But that's you got to get rid of that inflation hangover. The tariffs will cause some supply chain disruption. They won't cause inflation, but they will cause some supply chain disruption. That's a bit of a headwind for the economy. These government layoffs haven't, terminations, whatever you want to call them, haven't shown up in the unemployment figures yet. They will, but that's probably coming this summer because, you get laid off, but you get severance or you get a notice period or whatever, so you can't actually apply for unemployment until a little further down the road. So that's somewhat delayed, but that's coming. So we're going to see unemployment go up. We're going to see interest rates come down, but not for good reasons. It's nothing to cheer about. As I said, it's more a sign of recession than there's no stimulus from it. That's nonsense. So now this was not orchestrated, but it's happened. Now Americans bang the table about paying off the national debt. It's never going to happen. We haven't paid off the national debt since Andrew Jackson. 1836 was the last time the U.S. was debt-free. Where you don't have to pay it off. What you do have to do is roll it over, which was the genius of Alexander Hamilton. He figured that out. So what makes it sustainable? Interest rates cannot get too high and the dollar cannot collapse. Because this plays out in the foreign exchange markets. Everyone's focused on interest rates. Okay, fair enough, but you got to look at the foreign exchange markets as well. And by the way, if you want to put a thermometer in the patient's mouth, look at the dollar price of gold. Because everyone's like, strong dollars. I mean, it's been down a little bit the last couple months, but for a year and a half, the dollar was hitting new all-time highs, DXY, Bloomberg Index, and so forth. Well, against the euro, yeah. Against yen, Swiss francs, and pound sterling, yes. But they're all passengers in the same lifeboat. They're all going to sink or swim together. You're comparing currencies to currencies when you use those indices. What's the one yardstick, the one metric where you can gauge the value of the dollar without using another currency? The answer is gold. And with the dollar, it used to be, wasn't that long ago, it took $2,000 to get an ounce of gold. Now it takes $3,000. Well, that's a 1/3 collapse in the value of the dollar if you're using gold as your yardstick, which I do. But so all you have to do, you're not going to pay off the debt. The debt's going to grow. The debt's going to get bigger. But this, $36 trillion, it's a big scary number, but it doesn't matter. Come back to that ratio. If you see that ratio going from 125 to 120, 115, 110, that was heading in the right direction. That's a sign of improving health. That's a sign of sustainability. The market will continue to roll over the debt. So the math, at least for me, it was fifth grade math. I'm not sure what they teach these days, but what you need to do, you need to grow the economy faster than the debt's growing. But here's the key. When we do this ratio, you're in nominal space. I'm a big hawk on, you got to be real, take out inflation, let's talk real numbers. But this is one where it's nominal. If I owe you $1, I owe you $1. It's interesting if it's worth 90 cents or $1.25, but it's a nominal number. So if you have 3% real growth, which is what Besant wants, but inflation's 2 or 3%, which it is, you're going to have 5.5, 6% nominal growth. So if you get the deficit to 3% of GDP, and nominal growth is 5 or 6%, 3 real, 3 plus 2, 5 or 6 real, guess what's happening? The ratio is shrinking. In other words, the nominal economy is growing faster than the nominal debt. That means the ratio is going down and we're getting healthier. And that's his goal. That's what Trump's going to do.